Billionaire Ray Dalio, who is the founder of Bridgewater Associates, the largest hedge fund in the world, shares his most important economic and investment principles in a forum. So I decided to delve to that into this video. We will check onto his economic principles before we go to his investment principles, since you have to know the state of an economy before you can go an extra mile like I'm investing into it. So the economic principles will be treated in this video, and his investment principles will be treated in the next vlog. His economic principles have been slightly discussed on this channel, but I will summarize it up in order to appreciate the investment principles. These principles are not just for investors, but also words of wisdom which you could apply yourself to whatever time or circumstance that may present to you. An economy comprised of several markets sum up together. So a picture of an economy is a summary of how its various markets are doing. There are 4 big forecasts, 3 important equilibriums, and 2 levers, which I will delve into the later part of this video. So try to stay tuned to the end. An economy comprised of productivity rate, the short-term debt cycle, and the long-term debt cycle. Over a period of time, we raise our standard of living because we learn how to do things better. We become more efficient, and that's what is called productivity, the output per man hour. Now, let's get to the short-term debt cycle. Short-term debt cycle is also known as the business cycle. Central banks create credit when an economy is in a recession or when the rate of economic activity is very low. People can acquire more commodities, services, and financial assets with these credits since it offers them purchasing power. As a result, the economy improves when it is issued out. So, as the economy improves, demand grows faster than the capacity to produce. So later, as the cycle progresses, central banks apply brakes. They tighten monetary policies and hike interest rates. With this, the economy becomes slack. Unemployment rate rises and expenditure falls, bringing the economy down to keep commodity prices stable as possible. And after a while, this is also changed to its vice versa. Because credit is the commitment to repay money at a later date, it becomes extremely cyclic. The debt cycle begins with stimulation and ends with repayments, which means you can spend more than you earn when you have it, then have to spend less than you earn when to be paying back. So it just continues like a cycle, ups and downs. This is what is known as the short-term debt cycle, which lasts about 7 to 10 years on average. Now, we are on to the long-term debt cycle. Long-term debt cycle here also involves the accumulation of several short-term debt cycles. Because we all want things to improve, asset prices grow over time, markets rise, employment rates must climb, and so on. As a result, central banks regularly stimulate the economy, which they do this by lowering their interest rate. After some time, it reaches a point where interest rate hits 0 as a result of its consistency. So at this point, you can't lower it anymore. You can't have a negative interest rate in an economy, like you can't go and borrow money and pay back less than you borrowed. That's not possible. After a while or a period like this, the only way to stimulate an economy is to create money and buy financial assets, which we call quantitative easing or QE. Quantitative easing comes as a temporary way to cure an overheating economy and can't continue permanently. So when it reaches a peak, they can't do that anymore, or there are limitations. So we come to the end of the long-term debt cycle, which further explanation of it has been made in a video which I will provide its link on the description. The US interest rate hit 0 back in 1930s and 2008, and in both cases there were printing of money and buying of financial assets, which caused those financial asset prices to go up and more liquidity in the economy as well. As the rich, particularly who owns financial assets, in the reality, they become much richer, which widens the wealth gap between the rich and the poor. So as you can see, the issue of wealth disparity is what is fueling populism these days. Here, Redalio compared three equilibriums by central banks in dealing with debt crisis, and these include: 1. Debt growth is to be in line with income growth, thus required to service the debt. If debt growth rises faster than the income growth, that's going to serve the debt. Repayment becomes very problemsome. So, there is always an adjustment between income and debt growth. They always go by the pro forma way, like what is the ability for one to service the debt before it is issued out. 2. Economic capacity utilization is neither too high nor too low. If you have it pressing up too much over an overheating economy, monetary policy would be tightened and a correction will occur. And if you have it too low too, the economy will be depressed and there will be a lot of slack. So we always have to check, where are we now relative to our ECU? Because that's the key driver of this business cycle we encounter. Third equilibrium. The projected returns of equities are above the projected returns of bonds, which are above the projected returns of cash by appropriate risk premiums. In other words, the capital market generates the circulation of purchasing power in the form of credit, and the relationship between cash, bonds, and stock yields, as well as asset classes, which determines how money flows through an economy. He condenses on the fact that to have just cash in your account should have lower returns than bonds, and bonds should have lower returns than equities. In that manner, in terms of how the system works, central banks always set down or put money in certain specific places so that people with better ideas make profits off from it. People use money to create other level of economic activity and have to have some expected returns. And when that's not working, that means there's a problem somewhere in the economy. So there are key levers which forms as the driver of every economy, and these are the monetary policy and the fiscal policy. Monetary policy is the means by which central banks put brakes and gases when regulating their monetary system. When central banks have proper brakes and gases, it becomes a reflection of these three equilibriums just listed. And you may ask, how do they go about doing this, or how can they do that? If debt growth is too high relative to income growth, capacity utilization is high, and the economy is overstretched, monetary policy should be tightened, which is, as usual, raise your interest rates and lower the purchase of financial assets. And this tightening will change the projected returns of cash relative to bonds and equities. Or in other words, to break it down, rewarding should be done according to the associated risk premiums attached to it. Monetary policy is all about regulating money supply and interest rates, which affect aggregate demand in an economy. Whilst fiscal policy, on the other hand, is also using the levels of government spending and taxation to affect the aggregate demand in an economy. These are very similar in that they can use to try stimulate an economy in a recession and rein an overheating economy as well. So policymakers should always know how they differ and the best suitable way to apply them at a given time. This is how to drive those various cycles, and that's how an economy operates in a kind of a perpetual motion machine kind of a way. Make sure you subscribe the channel, like, and try not to miss out on the next vlog on the investment principles coming soon.